We begin with Chapter 7. In this chapter, we will analyze in detail the covered call strategy. The covered call position is used when the market outlook is neutral to slightly bullish. The strategy consists of buying or already owning 100 shares of the underlying stock and selling an out-of-the-money call option. Here we can see the risk graph of the position. What we are seeing is a graph with two axes. On the vertical axis, the profits and losses of the position are indicated, and on the horizontal axis, the stock price is indicated. It is important to mention that the graph indicates the profits and losses per share on the expiration date of the contract, and besides, the values do not include brokerage commissions. The maximum profit on this strategy is limited. The most we can make is equal to the strike price minus the stock price at trade initiation, that is, at the time of call sale, plus the premium received multiplied by the number of shares. On the other hand, the maximum loss that we are exposed to is also limited. The most we can lose is equal to the stock price at trade initiation minus the premium received multiplied by the number of shares. This occurs if the stock price falls to zero. The break-even point is equal to the stock price at trade initiation minus the premium received. The break-even point defines the profit and loss zones. In our case, for stock prices lower than the break-even point, we are in a losing situation. In contrast, for stock prices higher than the break-even point, we are in a profitable situation. Continuing with the analysis, the initial margin required to open the position is equal to the 50% of the cost of the shares. The call sold is covered by the shares. An increase in volatility hurts the position. Time decay helps the position. With respect to exit conditions, to fully close the position, we must buy the call and sell the shares. If the stock price is higher than the break-even point, we are in a profitable situation. Otherwise, we are in a losing situation. In the case that the stock is trading between the purchase price of the shares and the strike price, the position can be partially closed by buying only the call sold. So we will make a profit from selling the call, and at the same time, we will hold the shares. This will be analyzed next. When we open a covered call position, it is said that we are writing or selling a covered call. This strategy is also called buy right. In this graph, we can see the influence of time decay on the position. On the vertical axis, the profits and losses of the position are indicated, and on the horizontal axis, the stock price is indicated. The blue curve indicates the profits and losses at the time of call sale. As we get closer to call expiration, the curve of profits and losses is like the one shown in green. And finally, at call expiration, the curve of profits and losses is the one shown in red. We can see that as time passes, the value of the break-even point decreases. Notice how it moves to the left. And as the value of the break-even point decreases, the range of prices for which we are in a profitable situation increases. Therefore, in this case, time decay helps the position. Now we will see in detail the exit conditions of the position at call expiration. Suppose we buy 100 shares of Apple at $395, and at the same time we sell one call option with a strike price of $410 at a premium of $5.5. Notice that the call is out of the money because its strike price is higher than the stock price. Therefore, the break-even point of the position is equal to the stock price at trade initiation minus the premium received. In our case, 395 minus 5.5, which is equal to $389.5. Here in the graph, we indicate the break-even point, the initial stock price, and the strike price of the option. The break-even point is 389.5, the initial stock price is 395, and the strike price of the option is 410. Now let's suppose that at call expiration the stock price is $380, that is, lower than the break-even point. In that case, the premium received for selling the call is equal to 5.5 multiplied by 100, which is the price of a single contract, multiplied by 1, which is the number of contracts sold. That is a total of $550. On the other hand, as the price of $380 is lower than the initial price, we will be losing $1,500 for holding the shares, that is, from the long stock position. Therefore, although we received a total premium of $550, finally we will be losing $950 due to the long stock position. Of course, as the stock price is lower than the break-even point, we are in a losing situation. In contrast, if at call expiration the stock price is between the break-even point and the initial price, for example, $392, in that case, we will have the following. The premium received for selling the call is always $550. On the other hand, as the price of $392 is lower than the initial price, again, we will be losing for holding the shares, in this case, $300. However, despite this loss, as we received a total premium of $550, finally, we will be making $250. Of course, as the stock price is higher than the break-even point, we are in a profitable situation. If at call expiration the stock price is between the initial price and the strike price of the option, for example, $405, in that case, we will have the following. The premium received is always $550. But in this case, as the price of $405 is higher than the initial price, we will be making money from the long stock position. In this case, we will be making $1,000. Therefore, we will be making a profit of $1,550 with this strategy, $1,000 for holding the shares, and $550 for selling the call. It is important to mention that as the option expired out of the money, we are not obligated to sell the shares to cover the call. Thus, the premium received is an income for us, and if we want, we can hold the shares. This is the best scenario for investors who use this strategy, because, by selling the call, they are increasing cash income from the long stock position, and at the same time, they are not obligated to sell the shares. Finally, if at call expiration the stock price is higher than the strike price of the option, for example $420, in that case, we will have the following. The premium received is always $550. On the other hand, as the options sold will be expiring in the money, we will be obligated to sell the 100 shares at the strike price, that is, at $410. Thus, we will be making $1,500 from the long stock position. Therefore, we will be making a total profit of $2,050 with this strategy, $1,500 for holding the shares, and $550 for selling the call. Although we will be making the maximum potential profit for this strategy, we will lose the shares because we will be obligated to sell them to cover the call. Let's see an example of how this strategy works. Here we are seeing the stock chart of the eBay company. As we can see, on August 19, 2011, the company gave us a clear bullish signal because the stock touched support and was accompanied by an increase in volume and an RSI below 30%. As we said, on Friday, August 19, 2011, eBay gave us a clear bullish signal. In order to take advantage of that, suppose at that time we had decided to buy 1,000 shares of the company to invest over the long term. At the close of that day, eBay was trading at about $27, so the 1,000 shares would have cost us $27,000, or $13,500 if we had bought them on margin, that is, the 50%. A few days later, the stock started to rise until it reached the price of $31 on August 30, touching the 15-day resistance. That can be seen here. We bought the shares on August 19, the day we got the bullish signal, and a few days later, on August 30, the stock reached the price of $31, touching the 15-day resistance. 2 days later, the stock was failing to break through resistance at $31, so it was expected to continue to trade near $30 or $32. To make a return on our long stock position, suppose at that time, with the stock trading at $31, we decide to place a covered call. As we own 1,000 shares, we decide to sell 10 calls with a strike price of $32 and expiration in September 2011 at a premium of 60 cents. Thus, we would have received $60 per contract, that is, $600 overall. With the 1,000 shares we had previously bought, we would be covering the 10 contracts sold. Notice that the calls are out of the money because their strike price is higher than the current stock price. A few days later, on September 13, the stock was trading near $29.5. It is important to mention that the covered call strategy is used by investors who are bullish on the stock, but think that it may experience a slight fall or a period of quiet trading. Therefore, by selling call options, they are generating income from the options premium. It is recommended to sell the call options during rising trading days because on those days the premium is higher. As we had said, on September 13, a few days after selling the options, the stock was trading near $29.5. At that time, the calls were practically worthless, trading at a premium of 1 cent. The options were expiring in 3 days. If we had bought the contracts at that time, we would have practically locked in the entire premium received, that is, $600. In addition, we would have made a profit of $2.5 per share on our long stock position, because we had bought at 27. Thus, we would have had a total profit of $3,100, $2,500 from the stock, and $600 from selling the calls, making a 12% return on investment in only 25 days. The advantage of buying the contracts at that time is that we end with the obligation to sell the shares. 3 days later, at options expiration, the stock closed at $33.69. That can be seen here. 3 days after September 13, at options expiration, the stock closed at $33.69. At that time, the calls with the strike price of $32 expired in the money, so the owner of the contracts would have exercised his right to buy the shares at $32. So, if we had not previously bought the contracts, we would be forced to sell the 1,000 shares at $32. Therefore, we would have made a profit of $5 per share on our long stock position because we had bought at 27. Thus, we would have had a total profit of $5,600, $5,000 from the stock and $600 from selling the calls, making a 21% return on investment in only 28 days. Although we had been making the maximum potential profit for this strategy, we would have lost the shares. Here we can see the numbers of our example. The strategy consisted of buying 1,000 shares of eBay at $27, and then, with the stock trading at $31, selling 10 calls with a strike price of $32 and expiration in September 2011 at 60 cents. Therefore, our investment is equal to the $27,000 we must pay for the shares minus the premium received for selling the calls. The premium received is equal to 0.6 multiplied by 100, which is the price of each contract, multiplied by 10, which is the number of contracts sold. That is $600. So, our investment is $26,400. The initial margin required is equal to the 50% of the cost of the shares, that is $13,500. The calls sold are covered by the shares. The maximum profit we can make is equal to the strike price minus the stock price at trade initiation, that is, at the time of call sale, plus the premium received multiplied by the number of shares. That is $1,600. In addition, at the time of the sale of the calls, we already had a profit of $4,000 from the long stock position. On the other hand, the maximum loss that we are exposed to is equal to the entire money invested, that is, $26,400. This occurs if the stock price falls to zero. The break-even point is equal to the stock price at trade initiation minus the premium received. In our case, 31 minus 0.6, which is equal to $30.4. Here we can see the order we must enter to open the long stock position. It consists of buying 1,000 shares of eBay. In the side column, we select the action Buy to indicate the purchase of shares, and in the Position Effect column, we select the option To Open to indicate that we want to open a new position. The entered price is $27, and the order type is Limit. Here we can see the order we must enter to open the short call position. It consists of selling 10 eBay calls with a strike price of $32 and expiration in September 2011. In the side column, we select the action Sell to indicate the sale of options, and in the Position Effect column, we select the option To Open to indicate that we want to open a new position. The entered price is 60 cents, and the order type is Limit. It is important to mention that in a covered call, when the orders to purchase the shares and sell the calls are placed separately, that is, one order for the long stock position and another order for the short call position, single leg orders are used. In that case, we pay the brokerage commission for each transaction. Here is an example of the order we must enter to close the short call position. It consists of buying the 10 eBay calls that we had sold. In the side column, we select the action Buy to indicate the purchase of options, and in the Position Effect column, we select the option To Close to indicate that we want to close an existing position. Here is an example of the order we must enter to close the long stock position. It consists of selling the 1,000 shares of eBay that we had bought. In the side column, we select the action Sell to indicate the sale of shares, and in the Position Effect column, we select the option To Close to indicate that we want to close an existing position. If we buy the shares and sell the call options at the same time, the order to open the position can be entered using an order with two legs. Here we can see an example. Leg number 1 corresponds to the short call, that is, to the sale of the calls. And leg number 2 corresponds to the long stock, that is, to the purchase of the shares. In this case, the entered price is given by the difference between the purchase price of the shares and the selling price of the options. For example, 27 minus 0.6, which is equal to $26.4. This is the money expressed per share that will be debited from our account when the order is filled. In a covered call, when the orders to purchase the shares and sell the calls are placed simultaneously, that is, the same order for the long stock and short call positions, a multi-leg order is used. In that case, we only pay one brokerage commission. In the same way, the order to close the position can also be entered using an order with two legs. Here we can see an example. Leg number 1 consists of buying the calls we had sold, and leg number 2 consists of selling the shares we had bought. In this case, the entered price is given by the difference between the selling price of the shares and the purchase price of the options. For example, 29.51 minus 1 cent, which is equal to $29.5. This is the money, expressed per share, that will be credited to our account when the order is filled. Here we ended with the chapter Covered Call. In the next chapter, number 8, we will analyze in detail the long put position.